everyone, to Q2 2024 Market Commentary with Consilio Wealth. We are back to discuss the prior quarter, that would be Q1 of 2024, as well as give our outlook for Q2 and beyond. And on today's podcast, we're going to discuss a lot around interest rates, or I guess I should say implied interest rates, because that's really what seems to be pricing into markets right now. And we'll also just discuss some winners and losers of the first quarter. As always, I have to remind our listeners that the views shared in this commentary are always made in the context of a well-diversified portfolio and are not meant to be a recommendation to buy into or sell out of a particular area of the market. These views can and will change as new information becomes available, and we will periodically update this brief to keep you informed of changes. We always like to start there because at times we will discuss certain indexes, certain stocks, and we are never recommending to buy into or sell out of those particular areas of the market. All right, Hal, let's start off with the first quarter review. What happened in the first quarter? What was driving markets?
Well, if you looked in the news, a lot of bad headlines should have been driving the markets, but again, we've always pressed the point where news shouldn't be the market drivers, right? And I think that's what we got with all the negative headlines, specifically with like geopolitics. We saw some good performance. The market, and when I say market, it's the imperfect index of the S&P 500. We all know that there's more things to invest in the S&P 500. If that's your sole investment, we think you're over concentrated. But when we refer to the market, just for example's sake, I refer to the S&P 500. It was up 10% as of April 1st. So we had a good double-digit quarter. It felt like there was zero down days.
Yeah, it's a good Q1.
Yeah. And in the context of what's going on now, we're on April 17th. We're a little bit delayed in recording because I just got back into the country. But, as of right now, we're up 6% because we have a little bit of a pullback. Most likely driven by the rate story, as Chris mentioned. So outside of that, nothing really shook the markets. It's actually been a healthy upswing. Earnings in January was really strong relative to the year before even. So we saw a pretty good market response.
And you talk a lot about interest rates. So the market was pricing in how many rate cuts as of Jan 1? And what's the Fed said so far this year? What has the Fed said so far this year? And has that changed now what the market is pricing in?
Sure. Yeah, and the market rally is really incumbent on this. Starting in late October, we had high interest rates, and then the interest rates started to taper off. What that tapering off is the futures market is pricing in more and more rate cuts. So we actually started the year with an implied 6 cuts for 2024 as of December 31st, 2023. So how do we know that? Well, there's a market called the futures market and a tool, the CME tool. We provide a link in the newsletter, but that gives insight on the anticipated cuts really all year from the Fed. So we had insights on what the cuts were or intended cuts were for March, May, June, and July. And they all come with probabilities, right? What are the odds of rate movements? In this case, will be cuts, right? Sometimes, what are the odds of rate hikes? And this is what typically moves the markets. So who's participating in it? It's typically banks, institutional traders that are either hedging or speculating, mostly hedging, right? Because if you're a rate-sensitive business, you want to hedge some of that exposure. And if you think things are going to go bad, you're probably going to hedge or take off hedges because rates will go up or rates will go down in that case if things go bad, right? You get a geopolitical instance where trade imbalances occur, risk is elevated in the stock market, therefore rates could go down. Because guess what people are doing? They're selling their stock and they're buying bonds. And that increased demand lowers rates. The exact opposite happens too. But the CME tool is pretty valuable, where it does update daily, but it takes all those trades that I mentioned in just a vacuum there. There's lots of reasons to trade in the futures market, but I just gave a couple examples that are by no means like all encompassing, right? There's lots of reasons that you want to hedge or trade rates in the future, right? If you're a currency exchange person or currency trader, you have lots of reasons to do that. But the CME tool does track all those trades, track all the volume, and it gives insight on what traders are thinking in the future. And that's how we knew heading into the year that implied rate cuts were at 6, which is about 1.5% lower. And I'm sorry, I'm hearing a little bit of background. Yeah. But I think the run-up was caused in anticipation of those 6 cuts, and then therefore the subsequent, recent sell-off, which is about 4% in the S&P, is the unwinding of those cuts. So now we're expecting about 2 cuts for the rest of this year. And Chris and I have, been out on a limb all year saying no cuts this year.
So the market went from 6 cuts to 2 cuts. And what's the Fed saying that they're going to do?
The Fed said wait. The Fed's target is still 2% for inflation. They're still seeing sticky inflation. What I mean by that is just the super core, as they describe it, like a cost of a haircut, still wildly expensive, and they can't bring the cost of that down through rate hikes, right? So that is staying at about 3.5% for inflation, which is still nearly double the Fed target. So they are being cautious about cutting rates prematurely in their mind.
Didn't they say 3 cuts this year, and they're sticking to that story? They said wait, but didn't they say they're committed? They're not committed, but they keep repeating that we're going to cut 3 times this year.
Yeah, and I think what sparked the 6-cut assumption. The Fed did come out and say, "Hey, we're targeting 3 cuts this year." That's the problem with the Fed trying to predict the future with anyone. They just don't know how some of the prices will react, and that's the core measure of inflation, right? So if it's higher than everyone expects, like it has been, specifically in the U.S., everyone else's inflation is coming down in line with expectations. For some reason, the U.S. spending has really kept it elevated.
Wow. Well, we'll see how that unfolds here in the second half of the first half of the year. I think it'll be interesting to get through that halfway mark, see what the Fed's saying, see what inflation data is coming in at, and also see if consumer spending can stay high. It'll just be interesting.
For sure.
All right, let's shift over to AI winners and losers. What's going on with AI in the first quarter?
Yeah, if frequent listeners of the pod definitely hear me and Chris talk about this, but what I wanted to point out was the market doesn't blindly reward the AI winners, and the big difference at the time was Google's Gemini versus Microsoft's ChatGPT. Gemini had some difficulty with their AI image generation tool, where it was just creating pretty historically inaccurate outputs, and that created an issue to where they had to pull the AI off the market. They were promptly punished, and to be fair, Google has rebounded pretty nicely from that. But the big difference that I wanted to point out is versus crypto, where everyone was just jumping on the bandwagon. I think AI winners and losers is being richly rewarded or promptly punished by the market. You look at the picks and shovels side, where NVIDIA's done really well with the AI build-out, and so has Supermicro, which is kind of like the close cousin of NVIDIA. But the companies that were punished were like Intel, right? Even though they do have a foot in with the AI door, they're just not executing, and the market isn't blindly bidding them up relative to like the NVIDIAs of the world. So I think that's the big difference between, at least at this point, AI investment in crypto, or more of the speculative bets that we've seen in the recent memory.
So NVIDIA's been the clear winner, and not just in the first quarter, but they've been running up for quite a while now. But then in the first quarter, there was the announcement of a lot of these other big tech companies are producing their own chips. Microsoft's going to produce their own chip. I believe Google's going to produce their own chip. Apple, I believe, announced their own chip coming out, to power their phones, their AI. So what do you think that means in the future? Is that stuff actually, I don't know if we know how close it is to actually rolling out, but could that be pretty strong headwinds and competition for NVIDIA?
Eventually. The problem is chip foundries take, years to build, and Samsung's looking to build still, and it's been like 7 years to green light the chip plant. So that's why Taiwan is so geographically and politically important, because they are them and Taiwan Semiconductor are like one of the sole providers in the world, because they have functioning chip foundries, right? NVIDIA comes up with a new chip, they send the plans to Taiwan Semi. That doesn't really exist here, and I think that takes time for the U.S. most importantly to establish.
Interesting, yeah. So it all runs through. I mean, we know this. It all runs through Taiwan Semi, and so that's an interesting thought. That even if Microsoft produces it, you still have a bottleneck with the one company that can produce things with a high degree of not accuracy, but that. I know that other companies have tried to produce chips, but they're just not as good.
Yeah,
I'm at a loss of words. Just like the chips don't work as well. They can't get as small of devices and things like that. Something. I'm sure our listeners know exactly what I'm trying to say. But Taiwan Semi has a corner of the market in that, and it's hard to replicate.
Yeah, we're trying to push it with the recent, I forgot the name of the bill, Inflation Reduction Act. That's really pushing for states like Arizona and Ohio, who have already signed contracts with Taiwan Semi, with Samsung, to build chips domestically. But these factories take a really long time to build, at least to do them well, right? Because Intel, we all know, is just faltering pretty badly.
All right, let's shift over to our outlook for the coming quarter and just what do you think's going on in the coming year here, or the rest of the year?
Yeah, and I think if you listen to us, we love what the S&P's done, but you have to recognize there's more to investing than just the S&P. And I mentioned 100% portfolio. Again, depending on age, I think that makes sense for a lot of younger people, but depending on age and wealth, I think having everything in the S&P is overly concentrated. And in the newsletter, we point out that small and mid caps, right, are pretty ripe for relative value. If there's a market pullback, yes, they can get stung, but it's hard to injure yourself when you're falling out of a basement window. The run-up hasn't been as sharp. NVIDIA is not a mid-cap company. They're a very large company, right? I'm trying to pick... Netflix is not a mid-cap company, right? And these are high flyers. To capture the rest of the market, all you have to do, you could stay within the U.S. All you have to do is lower your cap exposure, meaning buy mid-cap and small-cap companies. Mid-cap companies in the last 3 years are up collectively 6.17%. Small cap companies are down negative 10%. And that's relative to the S&P up a positive 25% over the last 3 years. So if you think the S&P is expensive...
All that's over the last 3 years.
Over the last 3 years, yeah. So that includes the 2022 drawdown. So even if you stayed invested, you've done actually pretty well. But if you think the market's expensive, all you have to do is migrate down a little bit. By no means are we saying sell out of the S&P outright. Just consider your weights.
Man, that's a crazy chart. I just want to repeat that quickly. So in the trailing 3 years, this is as of like today or April?
Yes, as of April 16th.
As of April 16th, 2024, trailing 3-year performance on the S&P, positive 25%, mid-sized companies, positive 6%, and small companies down 10%. Wow. That's wild.
Yeah.
That's wild.
Yeah, and you could argue that the small and mid companies are more rate sensitive. They tend to have stronger rebounds than the S&P when the Fed finally does cut rates. There's actually quite a bit of data showing that once the Fed makes that first rate cut, small and mid cap companies outperform the S&P pretty handily.
We actually talked about that in our prior commentary. So if you go to our Q1 2024 commentary, which will be the post right before this on our website, we highlighted how during the calendar year of 2023, the S&P was the highest performer at about 26%, assuming all dividends reinvested, and mid and small were like 18 to 19%, roughly around there. But when you look since that Halloween rally through the end of the year, small companies were up 24, mid was up 19, and large, the S&P was up 13. And really, that's signaling that as interest rates are starting to get priced to come down, the Fed didn't do anything, but it was starting to get priced in, as we talked about earlier. These mid and small companies started to price in higher earnings growth because of the lesser spend on interest for debt service.
Yeah. So it could have been a preview of what could be yet to come with when the rates do come down, but again, I think that's an exposure relatively in terms of value. It might be a good place to look at.
Interesting. Yeah. Stay diversified out there. Past performance does not guarantee future results.
Yeah. And outside of cap size, I think you jump internationally, right? If you haven't been paying attention, a lot of people won't to this kind of thing, is Japan. Japan had been keeping up with the S&P, relatively speaking. They finally hit new highs after 30 years of going below new highs, right? They have demographic challenges that maybe we're going to be facing, but not until recently with like their negative interest rate policy, they've really been driving returns, right? They're still a manufacturing heavy country, and the yen has been extremely weak, and that means they can export pretty easily because other countries have more buying power relative to imports from their point of view.
That's so crazy to see their markets have done so well. They're like the best performing international market.
They are.
And it's because there's a little bit of a spark in their economy, I guess, huh?
Yeah, their Federal Reserve is the Bank of Japan. It's been super accommodative. Their reason is they've been trying to achieve 2% inflation, which they've actually seen deflation. And we've said deflation is bad. And a country like Japan, who's suffered through nearly 2 decades of deflation or not hitting their inflation targets, they're desperate to reinvigorate the economy and keep it sustained.
You also talk in here a little bit about how India has benefited from some of the reshoring away from China. Can you expand on that a little bit?
Yeah, if you want to find a market that's better than the U.S. S&P, look to India. Over the last year, India is up 27%. The S&P is up 23%. This is as of April 16th. So all the reshoring and all the Chinese politics and their real estate issues, Apple's shifting of iPhone production from China to India, you're seeing a lot of benefits from Indian companies. And again, to be fair, we are underweight emerging markets, but there are pockets like India and Brazil where we are feeling really good about those economies and their near futures.
Okay. Any final thoughts?
I think that was it. I just think you don't have to be too creative with your diversification, but just strongly consider how much exposure you have to the NASDAQ and the S&P.
Yeah, I think that's some good thoughts. Okay, wonderful. Well, thanks everyone for your time today. As always, we will post this alongside our written newsletter. All of that will be emailed out to everyone, as well as available on our website under the Insights tab. And if you navigate down to Market Commentaries, you'll see each of the this current one and each of the prior ones as well. All right, thanks so much for tuning in.